Our retail clients are currently working really hard to get ready for the new IFRS 15 and IFRS 9. These two new standards become effective for years beginning on or after 1 January 2018. For IFRS 15, they have to consider the new 5-step revenue recognition model, which is a big job. And for IFRS 9, they have to contemplate the expected loss model. However, the big one for our retail clients will definitely be IFRS 16 leases. The biggest change in the new IFRS 16 is that it changes the accounting requirements in the records of lessees. And we know retailers traditionally lease a lot of space, retail space, and therefore they are greatly impacted. So currently, if you're a lessee of an office building or a shop, you would have an even operating lease expense in your profit and loss, and you will have no asset or liability in your balance sheet. However, with the new IFRS 16, on day one, when you enter into a new lease for a rental space, you would recognize an asset and you'll recognize a liability. The asset is a right to use that premises, and the liability, your obligation to make lease payments over a period of time. Now, as you use the office space, you would depreciate the office space, and as you make payments, you will repay the liability and you'll have an interest expense. So going forward, we will no longer have that even impact on profit and loss. And remember, we'll have an asset and a liability in our statement of financial position. I would like to highlight 4 impacts for retailers. The first one is that currently you have an even operating lease expense, and therefore the impact on your profit and loss is fairly even. Going forward, in the initial stages of a new lease, you will have a bigger interest expense than at the end of that lease. Your depreciation will still be an even amount. But if you think about impact on profit and loss, initially in the early stages of a new lease, your profit and loss will be lower than at the end of a lease, or usually that would be the case. So that's the impact on profit and loss. The second one would be the impact on your statement of financial position. It is true that usually on day one, we recognize an asset and a liability of equal value, usually. That could change over the period of the lease because the asset is amortized or depreciated evenly. However, the liability reduces over time based on an amortization table. That's not the big deal, however. The big deal is that your asset on day one is a non-current asset, the underlying asset, the property. However, your liability have to be distinguished between a current liability, payments you'll make within the next year, and a non-current liability, payments that you'll make after the first 12 months. So if you sit back, there's no increase in current assets, but there's an increase in a current liability. So there's an impact on your net current assets. The third one would be the impact on your cash flow statement. Currently, all operating lease expenses will be part of your operating cash flows. Going forward, your repayment of your liability would be a financing activity, and your interest expense, you've got an accounting policy choice. Is it a financing activity or part of operating cash flows? So it even has an impact on the cash flow statement. The fourth one, the final one that I would like to discuss, is the impact on EBITDA. Earnings before income tax, interest, tax, depreciation and amortization. Now that number is expected to go up because at the moment when you calculate EBITDA, you would have to deduct your operating lease expenses or payments. Going forward, EBITDA is actually before depreciation, before interest. Therefore, EBITDA would increase. So the key takeaways for retailers would be, first of all, do you know what the impact of IFRS 16 would be on your bank covenants? If your bank covenants refer to net current assets, we know they will be impacted by IFRS 16. So look at your bank covenants. The second one is, what are your company's key performance indicators? What would users be interested in? Which ratios would they be interested in? Debt equity ratios, how would that be impacted by IFRS 16? The third one would be, how do you structure your bonus schemes, and how would that be impacted by IFRS 16? And the very last one, do you have the staff, the processes to deal with all these amortization schedules, all these journal entries for all the leases you have as a retailer? If you need any assistance, please contact us at BDO.